Before you invest in real estate, you need to learn the 3 key tax benefits for real estate in the U.S. tax code. The first is that you get something called depreciation. If you had a company that made bricks, you would claim as an expense on your tax return all the cost for the materials to make that brick. When you buy an investment property, it's not like that's a piece of material that you're going to turn into something else. And you probably didn't buy it in order to take the bricks off that building to sell to someone else. The cost of buying material to turn into something else, or buying one thing to resell to someone else, is called an expense. And since buying a building doesn't really work that way, there needs to be some way to account for the cost of that building on your taxes. That way is called depreciation. Simply put, it means you can spread out the price you paid for the building over time as a subtraction against your rental income. It's not an expense because you didn't write out a new check every year. It's called depreciation because the price paid for that building is spread out over time. Hi, I'm Mr. Retirement, and I want you to get more income, pay less in taxes, and avoid big retirement mistakes. Subscribe to my channel, Mr. Retirement, to learn how to get the most out of your retirement. Another part of the tax code for real estate is something called a 1031 exchange. When you have a stock you don't like anymore, you sell it, and you owe the capital gains taxes on the difference of what you sold it versus the price. When it comes to real estate, as long as you meet the rules, and there are some strict rules, when you have one property you no longer like, and you sell it so you can buy another property you like better, you don't have to pay the taxes right away on that sale, as long as you follow the rules. That's called a 1031 exchange. You are using the tax code to defer the gain on that property. If you bought a property for $1 million and you sell it for $2 million, when you use the 1031 exchange and meet all the rules, you get to transfer that $1 million cost basis to the new property. And that $1 million in gain is not recognized this year. It's deferred to the future. Another big help in the tax code for real estate is something called the step up in cost basis at your death. You might have heard of this when it comes to investments in your non-IRA investment account. The same rules apply to your real estate. Now, this doesn't help you, but it sure helps the kids. You might have paid $1 million for that building, and years later, it could be worth $2 million, $5 million, maybe even $10 million. And because of that step up in cost basis, when someone inherits the property from you, the government doesn't say, this building was bought for $1 million, it's now worth $10 million, go ahead and pay us the taxes on that $9 million gain. Instead, the government says, this building is worth $10 million, and instead of you finding all the paperwork and figuring out what the actual cost was from way back when, let's just pretend the cost was $10 million. And since a $10 million value minus the $10 million that we're pretending it cost equals $0, when you sell the building for $10 million, there would be no capital gains. While there are many tax advantages to real estate, there is no one perfect investment, which is why you're doing the research and learning all you can about investments and taxes. To make sure you're on the right track, check out my next video, 3 Things Conventional Retirement Wisdom Gets Wrong. I'll see you there.